I've not had a lot of comments about financial markets in Jay's Corner this year simply because there was nothing to report of note, of outstanding note. That changed today. This morning, I was giving a Q1 kind of very, very brief overview to what has happened and what I saw. And then, of course, I pressed send, and moments later, things changed. So I jinxed it. That's what I joked to some people. And let's just take a look at it here. And so, to newcomers to the newsletter, I use the phrase stocks for show, bonds for dough. And notably, if you turn on any or look at any of the media, what you'll see is, you know, a bunch of news about stocks. And that's understandable. The narratives are interesting. Nvidia this, Nvidia that. Understandable. Uh, but let's just take a look at what the innards are. And this is my point, which is that it's important to kind of understand the basis, the theory first, and then you can think about the result and think about the result makes sense. Because only when you do it in that order can you say, okay, this was randomness, or is there something that I have to actually pay attention to because it could be something more systematic. And let's just do that here. So this is what I mean by stocks for show, bonds for dough. Meaning that down here, this is the general formula for the price of anything. This could be your rental house. This could be a piece of real estate. This is a stock. This is a bond. This is an option. This is insurance. Absolutely. Okay. So any financial asset has this kind of thought process. And what I want to point out here is the denominator, which is R. And the denominator is the cost of money. It's called discount rate. And this is from Motley Fool. I think, Motley Fool is the name. And that's why I left its logo there. Very simply put. The issue is R can be stated here on the very top row of the flashing numbers, which comes from Thinkorswim, Ameritrade, Schwab. I guess it's going to be in a few days. Anyway, here it is here, this is the 10-year note future yield futures. So basically that becomes then R. And what we have today, as a very good example, is that it is increased by 0.121. Now, to everyday people, this looks like small, 0.12. Not very big until you look over at the next column, which you can see at 2.88%. And now you can see it gets bigger quickly, which is small moves here in what is now 4.32, are actually 2.93%. And this has a ripple effect on the denominator. And by ripple effect, it looks small here, but as you go out into the future, you can see it's squared. It'll be cubed. It'll be to the 4th power, to the 5th power. And in 10 years, this t will be to the 10th power. So we live in a world where people are afraid of math, but if you just wrote it down, just put 1.0432 to the 10th, you will see a pretty big number here. So what ends up happening as the denominator starts to move around, NPV, which is price, that's price or value, if you will, starts moving around more violently. I would have called two things. Number one is this is now notably higher now today than it has been 2.5 years ago. Notably, right? Because before R was 1.5% for the 10 years. This number up here would have been 1.5 kind of number. And so now if you change this from 1.5% to 4.32%, you have totally different numbers here. That all said, equity markets and risky assets, have returned back to basically their price where they were prior. How did that happen? Well, I would tell you the basics, which is it's not only absolute rate here, right? But it is speed, meaning that the rate of change at which the R moves will matter a lot. And the reason it matters can be seen in this graph here, which is that we're always here. We know this, meaning that you're always here today. Right? The past is the past. Financial markets are looking forward. That's kind of why I like this graphic, if you will. When the denominator, which was shown here, that I just spent the last few minutes talking about, starts moving around, up and down, wider, meaning that up and down by bigger amounts, 2.93%. What happens is this curve, even if 0 were identical, the outcomes start becoming more, the band becomes wider. And to you, any people who are in engineering or any science, right, this is the standard deviation of return. Standard deviation, volatility. When this happens, things are thought of as riskier. Now, risk has multiple angles. It's not only negative, right? It can also mean positive, ultimately, right? Because that means that some outcomes are very, very good. But to the saving and investing world, generally speaking, higher volatility is worse for risky assets, right? In other words, equity investors don't like increased volatility. And what is notably absent from any of my comments here today is the idea of talking about, well, earnings power, earnings estimates. Because the reality is a very good explanation to what has happened so far, candidly speaking, over the past year and a half, is that what happened is R moved a lot higher from 1.5 to 4, let's call it. What happened is the smartest guys in the room is where? The CFOs of companies. So what happened? What actually happened is all of the companies represented in this list. What did Facebook do? What Facebook is almost at its high. What it did? It slashed jobs, cost. It shut down cost. You can go and type in Meta on Google and look at earnings, press conference. And what you saw Mark Zuckerberg, who was boy genius, now, adult genius, basically talking about we are slashing jobs. Why? Because it cuts cost. And cutting cost increases the earnings, which are the numerator. So basically what ended up happening is they adjusted to the fact that R was much higher, and they slashed cost to increase C, which is money that it made. It got more profitable. It got more profitable quickly. Why? Because they adjusted quickly. A second reason is that, as I said, the smart guy in the room, the CFO. And now you can have another takeaway, which is bigger, actually, than financial markets. It's actually to everyday people's use, which is they saw that their cost of borrowing was possibly going higher. What did they do? They borrowed at the lower rate and locked it in. Huge. meaning that they said, look, it's not going to get better than 1.5%. Let's borrow a lot. Let's borrow a lot. And let's borrow at very favorable rates. So now if they, let's just say you own Jay's Rib Shack, which is the name that I use because I don't want to make it like investment advice of a particular company or another. It's not financial advice here today. But you can see what Jay's Rib Shack would have done. It would have locked in a borrowing rate much, much lower, right? And then try to raise prices on my ribs to get better C. And what ended up happening? Stock, company, whatever, more valuable. And on it went. And so this is the way that you can understand kind of what is actually driving markets. And now today, why would I choose today? So now let's just take a look here because, I have found it pretty interesting that the 10-year note interest rates, the denominator has been this stable. It's been quite stable without this degree of movement that we are seeing today in a long time. We've seen 2 basis points, 3 basis, which is 0.02, 0.03, plus, minus, and slowly drifting down. And then narratives about the Fed pushing it down, thinking that the denominator would keep going down. You'll see Fed expected to cut interest rates, which means expected R to be down. So it's important here that this formula isn't exactly correct, right? They took shortcuts here for understanding, which is understandable, which is should be expected 1 plus R, because this is talking about the future as if it is absolutely known. Well, it's absolutely known to Facebook, right? Because they borrowed for 20 years at 3%, right? So they locked in this lower R. But stocks, the equity part, however, still is riding on this single number. And this goes on. This is not news to the way that actual asset allocation works around the planet. A couple more things here, and before we make this into a 50-minute video, which I do not want to do. If this sounds complicated to begin, it is now actually far more complicated. Not less complicated, more complicated. And the reason is you can see these other line items that I'm keeping my eye out on because today caught my attention. And again, it's not a coincidence that I'm creating the video today specifically. Because not only is it that the 10-year interest rate has changed this dramatically to now 2.9%, but it is that these two numbers, which are foreign exchange, have changed. So now you can see what has happened is that this is the euro, has the dollar has appreciated by 0.44%. It's the other side of euro, right? So in other words, if you went to Europe today and you needed to buy euro and you use dollars, it is now cheaper. True. So the reality is that we don't have a world where you have, only American investors only investing in U.S. risky assets. That is not what's happening. What is actually happening is you have global investors looking across the planet and then buying assets around the globe, around the clock. Not here is the yen. Not here is the Thai baht. Not here is the Singapore dollar. Not here is the Swiss franc. And around we go. So the reality is that a euro-based investor is actually flat today. Pretty much break even. Why? Because it could have sold its stocks at minus 0.37% and then exchanged it back into its domestic currency into more euro. So the reality is, and this is what happens, is that the European, right, in Frankfurt, they've got a bill denominated in euro. They've invested in another country. They sell that, convert back to euro. Guess what? They have more euro today, not less. Not less. They have more. Even though it looks like US equities are down by 0.4%. The euro is cheaper by 0.44%. And around it goes. Swiss National Bank, Norway Oil Fund. In other words, capital amounts which are way bigger, making your mutual fund rounding error at best. Why does this matter to other individuals? And I'm going to point it out here. Not going to be a huge surprise. I don't to followers and people who have seen Jay's Corner on YouTube, paid subscribers, etc., readers of the newsletter. And we're going to take a look at it here, and let's see if I can, get it right. Yes, it'll be right. Nope, that's not exactly correct, is it? And so you have to understand, I'm doing like 5,000 things at once, and so now we've been trying to make sure to keep people's stuff private. Here it is. So this is the spreadsheet I use very, very frequently to explain financial concepts to people, called Mr. X. Not any particular person, obviously. Let me just shut down some of this other stuff here. Window capture 3, there we are. So now what has happened is that today in isolation doesn't matter, right? But what it does is it can change your balances here. And so now it's kind of about how you fit across all of these other things. Why? So that we are trying to get the optimal or planned for net worth under the idea that we have enough money to pay for expenses through time. Through time. And that's where I'm going to end it here. Through time matters. And the reason it matters, and this is why, for example, you'll see lots of applications or, some, phone app or et cetera, about just adding the sum for 1 year. That is not sufficient. That is not sufficient at all. Because, for example, if you have presumed, if you are withdrawing money today at a high rate and you have inflation, it can absolutely be that you run out of money later. I'm not saying that it's a panic or a crisis. I'm just saying that it just pointing out that 1 year in isolation, it's of use, don't get me wrong. It's not of unlimited use. Fairly obvious. Try to command the obvious first. Why is that important? And why today, etc.? It's because of this next slide here, this next picture here. And so let's just take a look at it. And this is sequence risk in value, right? So in other words, today in isolation as one specific day does not register, okay? I've given you kind of like the, microscopic view. I've given you the microscopic view, for example, on here, in the sense that, right? In the sense that what I'm doing here is I'm showing you this, which is, line by line. I've given you some information that just generally doesn't show up on CNBC because that's boring compared to, okay, what happened to Nvidia today, right? That doesn't sell, that doesn't get viewers. But here, to everyday people, the issue is that you can't have these persist. And this is why I make lots of videos or have these articles and how difficult my task actually is. And I'm not asking for your pity, but the fact is that you can see what ended up happening and what we need to try to avoid. And you'll then see the weaknesses or the steps that got skipped when you see 10-minute YouTube videos. Because this sequence risk here is important. And you can see you can hear me very frequently, the average is just of limited use. It doesn't do full justice to the types of things that, someone should be considering. Let's see if I can shut down some of this window capture stuff. I don't need to see these blinking lights, as entertaining as it might be, keeping me awake. Let's just see window capture. There, let's shut that down. So you can see value of book A, value of book B, very, very different. But the reality is that the average return on these columns is identical, right? So now you can see what ended up happening. And down here is, and I don't even remember where I copied this from, but if you lose in any period 20%, the next period you don't get to just make 20% in return. You've got to make 25%. So this is how this averaging can fail. Why is this important? The reason that sequence risk is so important is because of the fact that now it comes down to here. Because let's say you were here and you were at 100. And this has actually happened, right? Because if this were 2022, what you ended up happening is now this number on average is 80. And so now we're at 2024 and you can say we're at 100, but that's actually not what happened either. Why? Because during this period, let's say you had to pull out some of the money for cash and now you had to pull out 10 because my bunches of green onion went up in price. And oh yeah, by the way, I'm living check to check. I don't have enough cash flow up here in these other locations. So I had to withdraw. And now actually I'm at 70 because I need to withdraw 10. And that's probably too extreme, but let's call it 75. Right? And then I went up by 25%. Well, guess what? Now I'm this plus to the 1.25. And now I'm at 93.75. In other words, I have not returned back to 100. And now you can see then the also then related fact and why I just don't buy the idea of you just set it and forget it, or, stocks in the long run forever. Stocks to buy forever. You see this article all the time. I'm like, wait, what? Because it exposes you to this sequence risk. And now, in practical terms, now you've got this issue down here. So what are you to do? I would say you need to have a very good balance. First of all, the reason I started this video at all, right, is because over I continue to have challenges on window capture type things. Let's just see. There we are. So, the reason I started over here is to say, okay, I understand that this gets all the headlines. I get it, right? The media wants you to, Bloomberg, they've got their own bills to pay. That said, what we need to make sure is to understand how that affects this here to you. And in other words, this has to be understood so that you can then understand whether or not you can take the ups and downs of this. And the reason that I brought in the last picture is that because This doesn't get press. And the easy answer is, you just have this portfolio with this allocation, which no question about it, that is the number one determinant of your return. But even the return is not the full thing. The full thing is ultimately this. Because, like I like to say, and I'll end it right there, which is, you don't get to bring your brokerage statements and redeem them for groceries. With that in mind, I thought to give you a look on how I saw today and what has happened over the prior months. Quite stunning, to be candid with you. Quite stunning. Because of the fact that these moving parts that I've mentioned at the beginning of today's video, foreign exchange, interest rates stable and lower, and possibly, expectations of lower, right? What I said, expectations of lower here, right? Meaning expected lower are pushing up risky assets. That doesn't necessarily mean the coast is clear forever, right? The expectations can change. We'll leave the macroeconomics 101 on whether or not we think that interest rates lower or interest rates higher, etc., is correct. That's an entirely different crossfire with many layers also out of the public eye. That's it for today. Be sure to send questions, info@gh2benefits.com. This video isn't going to make it up onto YouTube. I just don't have the belief that, well, first of all, these types of videos give you some set of information that don't fit inside the YouTube algorithm, right? So if I release this video on YouTube, there'll be like 3 views and they don't push it out to other people. They don't find this interesting. They don't find this interesting. They don't find, this interesting. What they'll do is they'll focus on me just talking about sequence risk alone without actually showing you how they all, interact, tied together for ultimate financial outcomes. All right, everyone. Thanks.